Hi everyone, and welcome back to video number 2 in chapter 4. Here we were looking at receivables and how we present them. And here we see Stanley Black & Decker. They have their cash equivalents. They have accounts and notes receivable. Notice the term net there. That's after our allowance for doubtful accounts has been subtracted. And inventory, same thing, net. That's our um, where we're going to subtract out the lower of cost or market, net realizable value, that kind of thing. Then we have our prepaids and other current assets. All right. And here we break out that notes receivable into its pieces. We have trade accounts receivable, we have notes receivable, we have other accounts receivable, maybe from employees or that kind of thing. And then the gross accounts of notes receivable, and then we back out the allowance for doubtful accounts and that gives us finally the accounts and note receivable net that we see here. Okay, so inventories, we're going to disclose that on the basis of how we value it. And again, we have the lower of cost or net realizable value or the lower of cost or market. So the cost flow assumption then, of course, would be important as well. FIFO, LIFO, weighted average. So here is what Black & Decker did. And they show their finished products, work in process, and raw materials. Clearly a manufacturing company. So in the notes, they say our inventories are primarily valued at the lower of last in, first out cost or market because the company believes it results in better matching of costs and revenues. Okay, prepaids. You've seen this before, so this is generally review, but here we're paying some cash in advance for services and benefits that we're going to receive in the future. And again, the cash payment is before the expense is recorded. We're going to record the expense as we use up those prepaid expenses. So you often see that, as I'm sure you have in the past, a 1A or 101 course, prepaid insurance, supplies, advertising, prepaid rent, and sometimes taxes. Okay, so here we're showing our prepaid expenses here and other assets there. So there's our total current assets. All right, let's take a look at an example here. Koch Corporation's adjusted trial balance contains the following asset accounts at December 31st, 2025. They've got cash, land, patents, accounts receivable, prepaid inventory, allowance for doubtful accounts, and equity investments. And they want you to prepare the current assets section of the balance sheet, listing the accounts in proper sequence. So I'll give you a second or two to analyze that. And so here is how they do that. We're going to put these assets in decreasing order of liquidity. Of course, cash is our most liquid asset, so it's first. Our equity investments, generally we can go grab those anytime we want, so that's pretty liquid. Accounts receivable, after our allowance for doubtful accounts here. Inventory and prepaids. So our total current assets, $139,200. Okay, non-current assets. Now, these are assets that we intend to hold for longer than a year, or the operating cycle, which is ever longer. So here's our securities. We have a lot of those different kinds of securities, bonds, common stock, even some bank notes, long-term notes. Number two, we have tangible fixed assets. Tangible meaning it has physical substance. You can touch those assets. And they are not currently used in operations. Remember, this is going to be land, for instance, that's held for speculation. That's going to be not used. Then our special funds here, we have a sinking fund. That's where we put aside some money for paying back things like bonds. A pension fund where we accrue money in advance of people retiring. And plant expansion fund, that's pretty self-explanatory. And the cash surrender value of life insurance. And then number four, investments in non-consolidated subsidiaries or affiliated companies where we've invested in those. All right. Long-term investments, usually presented on the balance sheet below the current assets in a separate section called investments. Debt investments classified as available for sale are reported at fair value. Held to maturity debt investments are reported at its amortized cost. And equity investments are reported at its fair value or by using the equity method. Okay, let's take a look at how we present those. Balance sheet, we've got our current assets and our long-term investments. And here they've broken down those long-term investments into their pieces. Here we have debt securities available for sale, then mortgage loans and other investments, all totaling 17,314. Well, that's 17,314,000. And here long-term investments total that. Okay, here's an illustration. Included in Acctg companies, December 31st, 2025, trial balance are the following accounts. So they give prepaid rent, debt investments, unearned fees, and notes receivable and land. Okay, these are long-term notes receivable. So they want you to prepare the long-term investment section of the balance sheet. I'll give you a second or two to think about that. Okay, how we're going to do that, we're going to list our long-term investments as a classification. And then under that, we have debt investments, land held for investments, note receivable, long-term total investments. Okay. You will notice that unearned fees, land, and prepaid rent are not included in that. Okay. Property, plant, and equipment. Tangible, long-lived assets used in the regular operation of the business. These are non-current assets. We have physical property. Those are the easy ones. Land, building, machinery, furniture, that kind of thing. And in a mining company, I suppose, wasting resources of gold, silver, minerals. But with the exception of land, a company either depreciates them, in the case of buildings, land, and tangible assets. But if you have a mining operation, you would deplete those assets, such as gold and silver and oil reserves in this case. So here's Mattel, and they got their PP&E up here, property, plant, and equipment. They've abbreviated it PP&E here. And property, plant, and equipment, net, that means that depreciation has been subtracted out. The right of use assets, net, goodwill, and other non-current assets for Mattel. And so what they want to do is, here's these property, plant, and equipment at $550,139, and they show land, buildings, machinery and equipment, software, tools, dies, and molds, and leasehold improvements with a total here, less accumulated depreciation, gives us the net assets that are shown here at $550,139. Okay, let's look at an illustration of PP&E. Lowell Company's December 31st, 2025 trial balance includes inventory, buildings, accumulated depreciation on their equipment, the equipment, land held for investment, not land that we're keeping to put plants on or equipment in or something like that. 46,000 accumulated depreciation on buildings, and then land and timberland. Okay, and how that would look like this. We're going to prepare the property, plant, and equipment section of the balance sheet. And here's our land. Here's the buildings, accumulated depreciation on those buildings, our net book value for those buildings, equipment, accumulated depreciation on equipment, net book value, and then timberland. We add it all together, we get total property, plant, and equipment of $474,000. Intangible assets lack physical substance in that you cannot touch them. They don't have any they are limited life. Intangible assets would need to be amortized. We don't depreciate intangible assets. We call that amortization. But sometimes we have indefinite life intangibles, but we do test that for impairment. Okay, so what are indefinite life intangibles? That would be something like the Nike swoosh, that kind of like a check mark. It's really an artist's depiction of the wing of Nike. And so that particular intangible trademark is not losing value at all. It's just as strong, and it gets stronger every day as brand recognition. So that particular intangible would not be amortized. Probably wouldn't be impaired either, but it would be tested for impairment. Okay, so how does that look on the balance sheet for intangibles? Here, separate category, intangible assets. We have amortizable intangible assets shown net. That's after our accumulated amortization, which is rarely shown on a balance sheet. Here it's shown net, and then we have goodwill and other indefinite lived intangible assets that we do not amortize for our total intangible assets. Okay, so that looks like a good place for us to stop this video. And when we return, we'll take a look at this illustration of intangible assets. Until then, bye for now.